Here's a question. Have you ever opened a budgeting app, stared at 15 different categories, tried to track every single dollar down to the penny, and given up within about 2 weeks? You're not alone, and it's not because you lack discipline. It's because most budgeting systems are way too complicated to actually stick with long-term. Today I'm going to break down the one budgeting method that's simple enough to actually follow, flexible enough to fit almost any income, and backed by real behavioral logic for why it works when so many other systems fail. It's called the 50-30-20 rule, and by the end of this video, you'll know exactly how to set it up for your own life, starting today. Before we get into exactly how it works, you need to understand why so many people quit budgeting entirely within the first month, because the 50-30-20 rule was built specifically to solve that exact problem. Most budgeting advice online falls into one of two extremes. On one end, you've got the extreme detail approach. Track every coffee, every gas fill-up, every $20 impulse buy across 20 or 30 different categories. It works great for exactly the first 10 days, and then life gets busy. You miss a few entries, the whole system feels overwhelming, and you abandon it completely. On the other end, you've got vague advice like, just spend less than you earn, which is technically true but gives you absolutely no actual structure to follow, so you end up right back where you started, wondering where your paycheck went. The 50-30-20 rule sits right in the middle of those two extremes. And that middle ground is exactly why it works so well for so many people. It gives you just enough structure to actually guide your decisions, without demanding the kind of obsessive tracking that makes most people quit within a month. Here's the entire rule in one sentence. You divide your after-tax income into 3 buckets. 50% goes toward needs, 30% goes toward wants, and 20% goes toward savings and debt repayment beyond the minimums. That's genuinely the whole system. No 20 categories, no complicated spreadsheet formulas, just 3 numbers that add up to 100%. Let's break down each of these 3 buckets properly, because the exact definition of each one matters more than people realize. And getting these definitions wrong is one of the most common reasons this budget doesn't work for some people at first. The needs category covers the 50% of your income going toward things you genuinely cannot avoid paying. This includes your rent or mortgage payment, your utilities like electricity, water, and gas, groceries, not restaurant meals, actual groceries, your minimum debt payments, insurance premiums, and transportation costs necessary to get to work, whether that's a car payment plus gas or a transit pass. The test for whether something belongs in needs is simple. If you lost your job tomorrow, would you still absolutely have to pay for this to survive and keep functioning? If yes, it's a need. If you could cut it out entirely for a month without any real consequence, it's not a need, no matter how important it feels in the moment. The wants category covers the 30% going toward things that improve your quality of life but aren't strictly necessary for survival. This includes dining out, streaming subscriptions, that gym membership you actually use, hobbies, shopping beyond basic necessities, vacations, and entertainment. A lot of people get confused here because some of these things feel essential in daily life. But feeling essential and being essential are two very different things. Your streaming subscription feels important because you use it every night, but you would survive perfectly fine without it. That's exactly what puts it in the wants category, not the needs category, and the savings category covers the 20% going toward building your financial future. This includes your emergency fund, retirement contributions, extra payments beyond the minimum on any debt you're carrying, and any other savings goals you're working toward, like a house down payment or a big purchase you're planning for. This category is the one most people accidentally skip entirely, which is exactly why it's listed as its own separate bucket instead of being lumped in with whatever's left over at the end of the month. Now here's where the real value of this rule comes in. And it's something most explanations of the 50-30-20 rule completely skip over. The psychology of why splitting your money into exactly these 3 categories, in these exact proportions, actually changes your financial behavior. The first reason this rule works is that it removes decision fatigue. Every single financial decision you make throughout the day, should I get takeout? Should I buy this jacket? Should I upgrade my phone? normally requires you to weigh it against your entire financial picture, which is mentally exhausting and usually gets skipped because thinking that hard about every purchase just isn't realistic. With the 50-30-20 rule, you don't need to evaluate your entire financial life every time you consider a purchase. You just need to ask one much simpler question. Does this fall within my wants bucket for this month, yes or no? That's a dramatically easier decision to make consistently, which is exactly why people actually stick with this system longer than more complicated ones. The second reason it works is that it builds in permission to spend, not just restriction. Most budgets fail because they're framed entirely around restriction. Don't spend here, cut this out, sacrifice that. That kind of framing works for about 2 weeks before it starts to feel like punishment, and people eventually rebel against their own budget out of sheer frustration. The 50-30-20 rule flips this completely. That 30% wants category is a built-in, guilt-free spending allowance. You're not being told to eliminate fun purchases. You're being told exactly how much room you have for them, which is a completely different psychological experience. Permission within a boundary is sustainable. Pure restriction almost never is. The third reason it works is that the 20% savings category is treated as non-negotiable, right alongside your literal rent payment, instead of being treated as an optional afterthought that only happens if there's anything left over. This is the single biggest shift compared to how most people naturally handle money. Most people's mental hierarchy looks like pay bills, spend on things I want, save whatever's left, which usually means nothing gets saved at all. The 50-30-20 rule puts your savings on equal footing with your needs, which completely changes the outcome over time, even though the actual percentage, 20%, might not sound dramatically different from what people think they're already doing. There's a fourth reason worth mentioning too, and it's one that rarely gets discussed. The rule gives you a built-in early warning system for financial stress. If you calculate your percentages honestly and discover your needs alone are eating up 70 or 80% of your income, that's not a personal failure. It's valuable. Concrete information telling you that something structural needs to change, whether that's negotiating a raise, finding a roommate, or reconsidering a major fixed expense like a car payment. Most people go years without ever getting this kind of clear signal because they never actually sit down and calculate their real percentages in the first place. The rule forces that calculation to happen, which on its own is often more valuable than any specific budgeting advice that follows. Let's walk through an actual example so this feels concrete instead of abstract. Say you're bringing home $3,000 a month after taxes. Under the 50-30-20 rule, $2,500 goes toward your needs: rent, utilities, groceries, insurance, minimum debt payments, and transportation. $900 goes toward your wants: dining out, entertainment, subscriptions, shopping, hobbies, whatever brings you enjoyment day to day. And $600 goes toward savings and extra debt payments, your emergency fund, retirement contributions, or extra payments on any debt beyond the required minimum. Now, here's something important that almost every explanation of this rule leaves out. These exact percentages are a starting framework, not a rigid law carved in stone. If you live in a genuinely expensive city and your needs realistically take up 65% of your income, no matter how much you optimize, that doesn't mean the rule has failed you. It means you might need to temporarily adjust the ratio, maybe to something closer to 65-20-15, while working on ways to bring your needs percentage down over time. Whether that's through a roommate, a cheaper apartment, or negotiating some of your fixed bills, the specific numbers matter less than the underlying structure of dividing your money intentionally into these 3 purposeful categories instead of just spending reactively. Let's look at one more example with a different income level, just to show how this scales. Say you're earning $5,500 a month after taxes, further along in your career. Under the standard split, $2,750 goes toward needs, $1,150 goes toward wants, and $1,100 goes toward savings and extra debt payments. Notice that the actual dollar amount available for enjoyment and for savings both grow substantially compared to the $3,000 example, even though the percentages stay exactly the same. This is exactly why the rule works at nearly any income level. It's not a fixed dollar system that only makes sense for one particular salary. It's a proportional system that scales naturally as your income changes throughout your career. Let's talk about how to actually set this up in your own life, step by step, because understanding the rule and actually implementing it are two very different things. The first step is calculating your actual after-tax income, not your salary before taxes, but what genuinely lands in your bank account each pay period. This is your real baseline, and getting this number right matters more than people expect. Because building your entire budget off your pre-tax salary sets you up to overspend from day one. The second step is listing out every single one of your current expenses for the past month and sorting each one into needs, wants, or savings. This step alone is often eye-opening for people, because they discover they're spending significantly more than 30% on wants without ever realizing it, simply because those purchases happen in small amounts spread across the whole month instead of one large number they'd actually notice. The third step is comparing your current spending to the target percentages and identifying the biggest gap. Most people find their needs and wants categories are roughly where they expected, but their savings category is dramatically smaller than the target 20%, often close to zero. This is completely normal, and it's exactly the gap this entire system is designed to help you close over time. The fourth step is automating your savings percentage first, before adjusting anything else. Set up an automatic transfer for that 20% the day your paycheck arrives, so it happens before you have the chance to spend it elsewhere. This single action does more to make the 50-30-20 rule actually work than any other single change you could make. The fifth step is giving yourself permission to spend freely, within your wants percentage, without guilt, as long as you're staying within that boundary. This is genuinely part of the system working correctly, not a loophole or a failure. The entire point of having a defined wants category is so you can enjoy that money without a nagging sense that you're doing something wrong. Now let's cover a few of the most common mistakes people make when they first try implementing this rule, because a few small missteps can make it feel like the system doesn't work, when really it's just being applied incorrectly. The first mistake is miscategorizing wants as needs. This happens constantly, and usually without people even realizing they're doing it. Cable television, name-brand groceries instead of store-brand alternatives, a car payment on a vehicle nicer than what's actually necessary. These often get mentally filed under needs simply because they feel like a normal, expected part of life. But if you could genuinely survive without it, even if it would be uncomfortable or inconvenient, it belongs in the wants category. And being honest about that distinction is what makes the whole system actually function. The second mistake is treating the savings percentage as flexible while treating the needs and wants percentages as fixed. In reality, it should often work the other way around, at least at the beginning. If your budget doesn't balance out perfectly on your first attempt, the wants category should typically be the first place you look to trim, not the savings category. Cutting your savings first because it feels like the easiest, least painful category to reduce is exactly the pattern this rule is designed to help you break. The third mistake is applying the rule too rigidly in the very first month and giving up the moment it doesn't fit perfectly. Your very first month using this system is realistically going to involve some trial and error. Maybe you'll discover your needs percentage is higher than you thought, or your want spending is nearly double what the target suggests. That's not the system failing. That's the system doing exactly its job, which is showing you an honest, accurate picture of your spending so you can make informed adjustments, rather than staying in the dark about where your money actually goes. The fourth mistake is abandoning the rule entirely after one difficult or unusual month. Car repairs happen. Medical bills happen. A friend's destination wedding happens. These months will genuinely throw off your percentages, and that's completely fine. The rule isn't meant to be followed with rigid perfection every single month for the rest of your life. It's meant to be a consistent framework you return to, month after month, even after the occasional month that doesn't go according to plan. The fifth mistake is forgetting to actually update the percentages after a real income change. Getting a raise, switching jobs, or paying off a major debt should all trigger a fresh recalculation of your target dollar amounts. A surprising number of people set up their 50-30-20 split once, years ago, and never touch it again even after their income has changed substantially, which means the whole system quietly drifts out of alignment with their actual financial life without them even realizing it. Let's also address something people frequently ask about this rule. Specifically, what if your income is genuinely too low for these percentages to realistically work? This is a completely fair concern, especially in expensive areas or for anyone supporting a family on a single income. In these situations, the percentages absolutely can be adjusted, but the underlying structure of the rule, always dividing your money intentionally into these three categories, rather than spending reactively with no framework at all, remains valuable regardless of your specific income level. Someone might need to run something closer to a 70-20-10 split temporarily, prioritizing needs and still protecting at least some percentage for savings, even if it's smaller than the standard 20% target. The goal is progress within your actual circumstances, not perfectly hitting textbook percentages that were designed as a general starting guideline, not a strict universal requirement. Another common question is whether debt repayment fits into needs or savings. Minimum payments on any debt you're carrying belong in the needs category, since missing them has real, serious consequences. But any additional payments beyond the required minimum, extra principal payments meant to pay off debt faster, belong in the savings and debt repayment category, since that's ultimately building your financial future by reducing what you owe. Even though it doesn't feel like traditional saving in a bank account, people also frequently ask whether this rule works with irregular income, like freelance work, tips, or commission-based pay. The answer is yes, but it requires applying the same percentages to your income after it actually arrives, rather than trying to force a fixed dollar amount each month, regardless of what you actually earned. In a strong month, 50% might comfortably cover your needs with plenty left over. In a slower month, you might need to draw from savings you built up during stronger months to cover your needs percentage. The rule flexes naturally with variable income as long as you're applying the percentages to what you actually earn in real time, rather than an average that might not match any individual month. For anyone with genuinely unpredictable income, it also helps to calculate your percentages based on a rolling average of the last 3 to 6 months, rather than any single month in isolation. This smooths out the natural ups and downs of freelance or commission-based work, giving you a more stable baseline to plan around, while still letting you adjust more aggressively in an unusually strong or unusually weak individual month. Let's talk about why this particular rule has remained so popular for so long compared to countless other budgeting methods that have come and gone, because that longevity itself says something important about why it actually works. Financial systems that require the most effort to maintain are almost always the ones that get abandoned first, no matter how theoretically effective they might be. The 50-30-20 rule requires calculating your percentages maybe once, and then checking in periodically, weekly at most, monthly at minimum, rather than requiring constant detailed tracking of every transaction. This dramatically lower maintenance requirement is precisely why people stick with it for years. Compared to more detailed systems that typically get abandoned within a few months, it's also flexible enough to grow with you. Someone just starting their first job can use this exact same framework as someone 10 years into their career with a mortgage and kids, simply because the percentages scale naturally with whatever your actual income happens to be, rather than requiring completely different systems at different life stages. And finally, it gives you a genuinely simple way to evaluate any major financial decision without overthinking it. Thinking about a car upgrade, a new apartment, or any major expense, you can immediately check whether it fits comfortably within your needs percentage, or whether it would push your needs spending so high that it crowds out your wants and savings percentages. That single, simple check prevents an enormous number of financial mistakes that come from making big decisions purely based on whether you can technically afford the monthly payment, without considering the actual impact on your overall financial structure. There's also something to be said for how this rule handles the emotional side of money, which most other systems ignore entirely. Money stress rarely comes purely from a lack of income. It often comes from uncertainty. from not knowing whether a purchase is actually okay or whether it's quietly sabotaging your future. The 50-30-20 rule removes that uncertainty by giving you a clear, defined answer ahead of time. When you know exactly how much room you have in your wants category this month, spending within that room stops carrying any guilt or anxiety, and spending beyond it becomes an obvious, easy-to-notice signal rather than a vague feeling of having done something wrong. That clarity on its own tends to reduce the kind of chronic, low-level money stress that a lot of people carry around without even fully realizing it. Let's bring this all together with a realistic plan for actually starting this today, rather than just watching this video and moving on with your day exactly like before. This week, calculate your actual after-tax monthly income and figure out your target dollar amounts for each of the 3 categories based on the standard 50-30-20 split. Then go back through last month's spending and sort everything into these 3 buckets, so you can see exactly where you currently stand compared to these targets. Next week, set up an automatic transfer for your target savings percentage, even if you can't hit the full 20% right away. Something is genuinely better than nothing, and this single step alone will move you further than most people ever get with more complicated budgeting systems that never actually get implemented consistently. Over the following month, track your spending loosely, not with obsessive detail, but closely enough to notice whether you're staying reasonably within your wants percentage. If you go over in one particular month, that's simply useful information for next month, not a reason to give up on the entire system. And every few months going forward, revisit your percentages entirely. Your income changes, your expenses change, your goals change, and your budget should genuinely change right along with all of that. Rather than staying frozen exactly the way you first set it up, let's recap everything we covered today. The 50-30-20 rule divides your after-tax income into 50% for needs, 30% for wants, and 20% for savings and extra debt repayment. It works specifically because it removes decision fatigue, builds in guilt-free permission to spend within a defined boundary, and treats your savings as non-negotiable rather than as an afterthought. We covered exactly how to calculate and implement it, the most common mistakes people make along the way, and how to genuinely adapt it for lower or irregular incomes rather than abandoning it completely when the standard percentages don't fit perfectly. Remember this: the specific numbers, 50, 30, and 20, matter far less than the underlying habit of intentionally dividing your money on purpose. Instead of simply spending reactively and hoping something happens to be left over by the end of the month, that one shift, more than any specific percentage, is what actually changes your financial life over time. Whether your actual ratio ends up being 50-30-20, 60-25-15, or something else entirely based on your real circumstances, the habit of consciously choosing that ratio, instead of letting your spending happen by accident, is the part of this system that actually lasts. If this video actually helped you, hit that like button and subscribe, because we cover practical, no-fluff financial strategies exactly like this one every single week. Drop a comment and let me know. What percentage split are you actually running right now before making any changes? I genuinely like to see how close or how far off most people already are from this rule without ever having consciously followed it. In the next video, we're covering how to actually build your very first budget from scratch using this exact rule, with real numbers and a template you can follow along with step by step. So make sure you hit that bell icon so you don't miss it. See you in the next one.